So this video is going to walk you through exactly how you, no matter what your current tax bracket is, can save thousands of dollars on your taxes. I'm a registered CPA, and every single day, my firm and I help people just like you optimize tax strategies so that they can save more of their hard-earned money every day. You see, people often sit around thinking it's impossible to implement efficient tax planning unless you are a multimillionaire, spending thousands of dollars on a fancy accountant. However, that's not true. No matter what your tax bracket is, there are simple and effective tax strategies you can use to pay as little as humanly possible to the government. And that is exactly what we will be covering today. I'm going to guide you step by step, not only through what these strategies are, but also how you can implement them in your own life. All right, let's dive into it. So the first thing I want to talk about is what are the different tax brackets, because then we're going to be talking about specific strategies for each tax bracket. So let's start first. Tax brackets, the 10 and 12% tax bracket cover income from $0 to $47,000 if you're single and $0 to $94,000 if you're married. So that's the 10 and 12% tax brackets. The 22 and 24% tax brackets cover income from $47,000 to $192,000 if you're single and $94,000 to $383,000 if you are married. The 32 and 35% tax bracket cover income from $192,000 to $609,000 if you're single, and $383,000 to $731,000 if you're married. And then the 37% tax bracket covers income anything above that. So if you're single, over $609,000, and if you're married, over $731,000. So those are the main tax brackets: the 10 and 12%, 22 and 24%, 32 and 35%, and then the 37%. Now today we're going to break down each tax bracket and what strategies that are going to be most beneficial for you in that specific tax bracket. So let's look at the 10 and 12% tax bracket first. One of the biggest strategies that we talk to people in this bracket about is this idea of maximizing deductions and after-tax versus pre-tax dollars. And within TaxSale, we have entire modules that talk about this and how it's beneficial for everybody at every tax bracket, but we talk about exactly what things you need to do to implement different strategies. And then the concept of this is just how do we turn spending that we're already doing from after-tax spending into pre-tax spending? Because so many times we think that in order to maximize deductions, we need to go out and buy things that we don't need. And that's not the case. This is the simple concept of saying, hey, we're going to do these things anyways, whether we're a business owner or not, but how can we find a business purpose and move it from after-tax spending into pre-tax spending? So some examples of strategies here are the home office, automobile, meals, travel, having a board and holding regular board meetings for your business, cell phone and internet costs, technology costs, all these different things. We're saying, okay, let's find business purpose to this spending and let's make sure we're running it through the business and getting a deduction for it. Again, within TaxSale, we talk about this all the time and deep dive in every single one of the little strategies that kind of this idea of maximizing deductions encompasses. So why this specific tax bracket? Because you can look to likely eliminate a good portion of your income if you're in this tax bracket by simply maximizing deductions, by simply taking what's available to you as a business owner to take advantage of for that. Now, we can use the strategy at all income levels, but this is especially important for you at this income level. Why? Again, because you have the income from the business income that we can likely significantly reduce your business income through maximizing deductions and bring it fairly close, and oftentimes, we bring it as close to zero as possible, and that is very doable. Now, the next strategy in this is we want to talk about is a Roth or traditional IRA and funding one of these retirement accounts. So basically, a Roth IRA is where you don't get a deduction when you put money in, but the money sits in that account, grows tax-free, and has tax-free withdrawals once you hit retirement. So when you're in a low tax bracket, it is really good to fund a Roth IRA because you're putting money in. You're not getting a tax benefit from it, but you're in a lower tax bracket. So the tax benefit is not going to be as beneficial. But that growth and that withdrawal during retirement is all tax free. Now, the maximum you can put in a Roth IRA for 2024 is $7,000. The other option is a traditional IRA. That's where you get a tax deduction going in. It grows within that account, but then when you withdraw during retirement, it will be taxable. So we highly recommend this tax bracket. Take advantage of the Roth IRA while you're at that lower tax bracket, because as a business owner, you're going to go into a higher tax bracket. Now, we specifically recommend it at this level because your income's at a level where that $7,000 and is a really good number to be funding. Now, basically to do this strategy, you just got to find out how much you want to put in towards retirement. Again, $7,000 max. That's per person. So if you're married, it's $7,000 for each of you. And then you open an account and fund it. You can do both a husband and a wife account for this. So for the 10 and 12% tax bracket, we recommend maximizing deductions and funding a Roth IRA, or at the very minimum, a traditional IRA. And we dive deep into these strategies within TaxHelm. So now let's talk about the 22 and 24% tax bracket. We're jumping up a little bit in income. The first strategy we look at this tax bracket is the S corporation. Now you hear me talk a lot about the S corporations, and we deep dive into various different aspects of the S corporation within TaxHelm, but the core concept of the S corporation is to minimize self-employment taxes, because as a sole proprietorship or a single member LLC, you pay self-employment taxes on 100% of your income. And so now that you're jumping into this 22 and 24% tax bracket, we want to look and say, how can we help minimize the amount that we're paying in self-employment taxes? And so typically say once you have $50,000 or more in profit in your business, that's when it starts to make sense. And why don't we do it before then? Because the S corporation has some complications. We have to have a separate business tax return. We have to run payroll, reasonable salary to ourselves as the owner. So there's a lot of things that we need to make sure that we're doing correctly. And if we're at income below that level, it might not be, the benefits might not outweigh the costs. And so that's why in this tax bracket, an S corporation is a great strategy. Now, how do you do it? First off, you have to have an LLC or a corporation set up. You elect S corp status, and then you start taking that reasonable salary that you're required to as an owner. Now, S corporations can get very complicated. And with all strategies, we want to make sure we're dotting our I's and crossing our T's. And that's why we have an entire module of multiple lessons specifically on this within TaxHelm, so that we can ensure that we get this right and make sure that business owners are implementing and doing this correctly. Now, the second strategy in the 22 and 24% tax bracket is this idea of hiring your kids. And hiring your kids is a great opportunity where you can, again, let's look at the idea of we're going to support our kids no matter what. But how can we now hire our kids in our business, find something for them to do in our business, get a business deduction for it, and they potentially pay no income tax on? That's a win-win-win for every situation. And so it's a great strategy that we recommend at this level. Now, why at this level? Because when it starts to make sense with an expense level at this. Now, we've seen people with lower levels hire their kids, and of course, higher levels hire their kids as well. But this is a perfect spot that we see really most people diving into this strategy. Now, this idea of hiring your kids can be a great strategy, but we got to dot our I's and cross our T's. It's important that we do correct implementation there. We need to make sure that the kids are doing a valid real work within our business. We need to make sure we're paying them a reasonable rate. We need to make sure we have our entity set up and the way we're paying them and all that type of structure. So there's a lot of things that we need to make sure we're doing correctly, but it can be a super powerful strategy that I recommend to everybody. If you have kids in an age range that makes sense, in the 22 and 24% tax bracket, we recommend this to everybody. And again, within TaxHelm, we deep dive and have downloads, templates, guides, everything that a business owner needs to be able to implement this idea of hiring your kids in your business. Now let's jump to the 32 and 35% tax bracket. Two main things that we talk about to business owners when you get to this area. And the first one is to fund a solo or safe harbor 401k and fund that 401k, because now at this income level, you're starting to have some extra income allowed. You're making more than you're spending, and you have that money that you can put away towards savings. So we say, let's fund these retirement accounts to the maximum. So we're no longer looking at a $7,000 maximum. Now we're looking up in the $60,000, $70,000 that we can fund a retirement account. And so if you have no business or you have no employees, we recommend a solo 401k. If you have employees, we might go down that route of a safe harbor 401k. But at this income level, again, we're starting to have some of that extra income that we want to put in tax advantaged vehicles. And that's where a solo 401k or safe harbor 401k can be a great opportunity, where you can also do a Roth contribution in those as well for the employee portion. So how do we do it? We determine, okay, do I have employees or not? Let's determine what type of account we need to open. We need to open the account and fund it, and make sure we're running all that through payroll and dotting our I's and crossing our T's on all of that. And, within TaxHelm, we have a tax partner directory that we actually have a partner that we focus on, that we can get you in front of them. They'll do an analysis of everything you have and really kind of guide you and hold your hand into implementing exactly what strategy or what retirement account's going to make most sense for you and your business. But the second strategy in this 32 and 35% tax bracket is we start to talk to business owners about investing in real estate. Now, real estate can be super powerful for not only of a wealth growing opportunity, but also a tax opportunity. And real estate can really bring into power when you have a spouse that is a real estate professional that works in the real estate industry, because then if we're creating losses in real estate, we can use that to offset W-2 income or business income. But many people stop there and they say, well, we don't have a spouse that's a real estate professional, so we're going to stop there. And that's where the danger is. Because with real estate, let's think of it from a wealth building standpoint. It's a powerful tool. Most millionaires that you see out there have some sort of real estate in their portfolio. So it's a wealth building tool, but let's think about it this way. Real estate often has losses early on in the life of a real estate project, a rental property. So when we're investing in real estate, we're cash flowing, but we're creating losses on paper due to depreciation. So this is a way, let's say you're making $500,000 a year, but you have a property that's now cash flowing $50,000 a year. Now your income's up to $550,000 a year, but that property is cash flowing $50,000, but it's showing a zero. It's showing a loss on paper. So you're making $50,000 more per year, but you're not paying taxes on that. And that's the power behind real estate over and above the wealth opportunities as well. So that's the 32 and 35% tax bracket. Now, when we talk about real estate, again, this level opens that door for it. Why? Because you have some of that additional income. You have that opportunity to invest. Now, a lot of people don't even know where to start with real estate. And so that's why within Tax Zone, we did a whole series on real estate. And we also have a partner that we can get you in front of that says, hey, we'll help you find the properties. We'll help you manage the properties. We'll help you along this way. And it's a great opportunity to get started and get your feet wet in this idea of investing in real estate. Finally, let's talk about the 37% tax bracket. This is the highest tax bracket. These are what we call high income earners. When we get to this strategy, when we get to this level, we start to look at what we call advanced tax strategies. And so there's a lot of different opportunities. And, these are some of the things that that we see business owners that are making those high dollar amounts. This is what we are implementing. So when we look at advanced tax strategies, we're looking at things like tax advantage investments or different purchases or equipment that you're purchasing or some type of charitable type structure or strategy. Or maybe we're looking at various business structures or estate planning and many different opportunities when we get to this highest tax bracket. Now, why do we save some of this advanced planning for this highest tax bracket? It's because, first off, this tax bracket, you're paying a lot of taxes, and they have costs. Many of these strategies that we implement at this level have costs associated with them. So if we implement them at a lower tax bracket, some of the savings that we get from it would not outweigh the costs associated with them. But when we have a bigger tax bill from more income and a higher tax bracket, then the cost definitely makes sense. Also, some of the advanced type strategies work with have minimums. So we need to invest this amount of dollars, or we need to invest this point, where at a lower tax bracket, that might not make sense. So that's when we start to, at this tax bracket, start to look into advanced type tax planning. Now, this is very important. When we get to advanced planning, you're often working with a provider that specializes in this specific type of strategy, whatever that strategy might be. And it's important to have trusted and vetted partners that you're working with when it comes to advanced tax strategies, because you want to make sure you're dotting your I's and crossing your T's. You're going to be saving a lot of taxes using various different strategies, and you want to make sure that you're doing everything correctly to stay off the IRS radar. And that's why within Tax Zone, we have partners. We vet, we look, we do our due diligence on different strategies and find the partners specific for you that's going to make sense based on whatever that advanced tax strategy it is that you're looking to implement. So now you know the exact strategies that you can apply depending on your tax bracket. However, there are two paths forward for you. You can go and apply these strategies yourself, falling into the common pitfalls and mistakes people make, especially nuanced ones that I have not been able to cover in such a short video. Or you can join our software Tax Zone, where we literally take you by the hand and help you implement these strategies into your own life so that you can begin to save thousands in taxes. Click the link below this video to get started.